Good afternoon. I'm Philip Toffel of Sage Hill Family Office. I'm here today with our President and Chief Portfolio Strategist, Frank Antelek. Uh, Frank is an economist. As most of our audience knows who know us, I'm a tax attorney, and the combination of what Frank and I do as a family office is to oversee all of the legal, financial, and investment, tax, family issues within family business ownership on behalf of our select client groups. So today our topic here is to talk about the very prominent issue we all see today, and that is volatility in the financial markets. And we'd like to give you just a little bit of perspective relative to this issue, and we're going to spend about 15 minutes with you today just introducing very high-level topics and get the benefit of Frank's experience and Frank's knowledge in this area. So to give you just a little bit of perspective, with Sage Hill Family Office, we represent about 25 very successful families, to a large degree owners of family-owned businesses, looking at first generation as it flows into second, third generation, and people who have been very successful in what they do, whether it's manufacturing, real estate, food service, and the like. But people who started with a blank sheet of paper and created a lot of wealth, worked very hard to do it. And very legitimately, our clientele are very concerned about not losing what they've worked so hard to achieve. And so they certainly don't want to be so conservative with it as to be in 30-day treasury bills, by example, but want growth within their personal lifestyle assets in their charitable trusts, assets in their trusts for their children, future generations, for multiple purposes, and for their employees and the like. So it needs to be balanced, but in the vast majority of cases, with our clients being truly financially independent, on paper, they want to make it real. They want to make sure that the cash flow required over their lifetimes and over the requirements for their charitable causes and the like is very stable. So to collapse that very broad volatility, particularly now, but it's always there, isn't it, Frank, in terms
Sure.
of that volatility. So clearly, Frank is the expert in the room on these topics, certainly not me, but together we work on the strategic issues. So of course, what we used to call the $64,000 question is now more of a $6.4 million question, I suppose, Frank, is if we can start at 30,000 feet, in terms of how we believe one should deal with the extraordinary volatility in the marketplace. Just as an example, on Friday we saw, of course, the market way down, close to 800 points in terms of the Dow Jones Industrials. Today we see the market up with the hopes of some trade balance with China. But I don't think most of us really trust that day to day it's going to be calm. So let me defer to you now that I've given the preface of where do we start at 30,000 feet on this issue.
Sure. Well, I think a couple things I'd pick up on in what you were just identifying as issues that clients and other individuals that have saved money and put wealth aside, what they ultimately are trying to do is find a way to live off of the resources that they've built up over a lifetime. And I think anybody in that situation looks at their wealth as a storehouse of value, and how can I take that value over my lifetime and use it to my benefit. But if I've accumulated enough wealth that I can benefit others, then how can I also use some of that wealth for family members or charitable individual or business partners that I've had in the past. So it really becomes, in my view, a process of understanding what I need and how do I get there. How do I put my dollars aside in a way that I feel comfortable that going forward they'll be there in the future. And the volatility that you just referred to is always going to be in the marketplace. And what we try to do is we try to give the client the ability to not really be overly concerned about short-term volatility and to be really focused on the longer term. And one of the ways that we've really developed our strategies is to create cash flow. I don't like to use the word income because income is a taxable item that really represents the yield on an investment, and really what is more important is the cash flow. What cash is being generated out of your portfolio to provide the needs that you have going forward. And when we develop a program that takes cash flow and enables you to feel that the cash flow will be continued when you're not working, and that those dollars coming in will feel like a paycheck, that's when you feel comfortable and that you feel that you have security in your retirement. So a lot of the investment work we do is really designed around providing cash flow when it's needed by our clients, so that they have that comfort that the money is there, and then they don't have to worry about short-term fluctuations in the stock market, and they don't have to be concerned about changes in interest rates and what will they be generating. If we can find methods of security that guarantee the level of cash flow that's coming into the client's hands through their portfolio, then they have a lot more security and are able to live their lives without concerns.
Yeah, but you and I are old enough, to have seen October of '87,
Mm-hmm.
right?
Yeah.
So that was a one-day event that was catastrophic, and very few people, as I recall, saw that. At that point, it was a 500-point drop, which
Sure.
in today's world, that happens a couple times a week. But so we saw that. Of course, we saw what happened in the internet bubble in 2000, 2001, 2002. Of course, we saw 2007, 2008, and I'm not really being critical of intentionally critical of a lot of portfolio managers, but what I see, and I believe certainly you see out there, is that the norm seems to be, let's create for someone who is even financially independent, let's create an allocation of, call it 60% equities within a mix within equities of international, domestic, large cap, small cap, growth, value, etc., some fixed income, some cash equivalents, maybe a little tilt with some alternative investments. When I ask the question of people who manage money that way, well, what's your intention of when you sense that the market is going to have a real downside slope to it, and sometimes these downside slopes are cliffs. Mm-hmm. They're not slopes. It's not always a recession. Sometimes it's a catastrophic event. Correct?
Right.
And what I've experienced with people is that even if they can anticipate a recession or a downward slope, that there's a real life emotional aspect to this, in that people didn't immediately get out when there was a hiccup in 2007. Right. They saw some losses, they saw some downward sloping of their portfolio. And maybe they got out of equities to a large degree when they were down 15-20%, and there was still more downward pressure. But then when things started to come back, did they just automatically get in? Not in what I saw out there. So what I'm teeing up for you here is our philosophy, of
Sure.
course, where we don't want people to have to try to time when to get out, when to get in. Let's create a more balanced environment where they don't have to go through that emotional turmoil.
Right.
And it's not just about people's health, but that's certainly a factor, but the stress that goes along with it. And do they have the courage to get back in?
Right.
So, as you can tell, I'm starting to get a little more practical in my question here, as to perhaps what are some of the nuts and bolts in terms of managing cash flow as opposed to income,
Right.
as to how we can accomplish the goals of not having to necessarily time when to get out and in, and make adjustments to the portfolio.
I understand where you're going with that, but I also want to talk about how we've been accustomed to seeing the markets go down and then come back. So the individuals that don't get concerned about the market and have the attitude, well, the market always comes back, that concerns me, because it has in the past. That doesn't mean that it will in the future. And I see a lot of attitude about that in the marketplace that presumes that it will always come back and always be higher. Yet you can look at periods of time in the market, you can go back into the 60s and look at a whole decade where coming back meant that you had 10 years of no returns in your portfolio. And while it did come back, if you are retired and withdrawing money from your portfolio, and let's say you're withdrawing 5% of the portfolio value each year with the assumption that, well, on average I'll earn 5% per year, so as long as I take only 5% out by the end of the decade, I'll have taken out all the money I need, and my portfolio, just as long as I earn 5% per year, will be at least at the same value 10 years later. If you have a decade and you're pulling out 5% per year and there are no returns, your return is going to be negative 50 in your portfolio. Even though the stock market is break even, your personal portfolio will be down 50%. And then at that point, when you're 10 years older, let's say this started for somebody that retired at age 65 and they went through that 10-year period, now they're age 75. And if they want to continue with that same lifestyle, that 5% withdrawal is now on half of their money, so it's equivalent to a 10% withdrawal. And I think we all understand what would happen if you continue to pull out 10% per year and didn't have that type of return in your portfolio. So I see that as big a risk as the individual that says, well, I'm going to preserve that what I expect to be a down cycle. I'm going to try to preserve some of my money by pulling some of my money out of equities and into bonds or just into cash. Those individuals run the risk of missing the cycle and putting their money back in after the market has recovered. And most studies that you look at will show that the timing aspect that for most individuals doesn't work to their advantage. They do end up pulling out as the market's going down and getting back in after it's recovered, and they end up trading in and out at prices that are lower on the sell side and higher on the buy side, and you're not getting the golden rule of investments, buy low and sell high in that situation. So just normal fluctuations in the marketplace, normal emotion with investors tends to create a little bit of a challenge in getting that right. So I think the attitudes of buying and holding could be disrupted by long-term periods in the marketplace where there are no rates of return, and for somebody that's trying to make withdrawals, it could be very devastating. For the person that's a little bit risk adverse and takes their money out as the market starts to correct, again, that can be harmful. So if you develop a portfolio that enables you in any market environment to kind of hold your course and to create some type of return, even in an environment where the stock market isn't performing, I think is critical. So that's really where we've tried to build our portfolios, is to find portions of the portfolio that will perform well in all market environments. So we utilize certain investment vehicles to provide what I would call absolute performance in any market environment, so that you do have the cash flow that's required. Typically we'll use bonds as a means to provide cash flow because we can set that up in the portfolio and know exactly what the client will get down the road from that portion of the portfolio, while other portions of the portfolio will continue to grow. We'll have protection from down market cycle through hedging in a way to make sure that the principal value that is there, that needs to be preserved for the longer term, is protected on the downside.
I'd like to drill down a little bit on that, because as you and I recall, when bond yields in the corporate bond market and the municipal bond market, particularly for our clients, the spread between corporates and munis is thin enough for us, for a high tax-paying client to typically be motivated towards munis in that respect, generally, right? And treasuries to a certain degree. But, we go back a few decades when somebody could expect a reasonable yield, call it 5% as a general number, right? You would develop the municipal bond portfolio, maybe some flavoring with some corporates and treasuries, and that would be your stable cash flow,
Yes.
right? You'd look at the credits that you were acquiring, the states, the local communities. Is it a revenue bond? Is it a general obligation bond? Particularly in states like California when they were in trouble. Illinois, right? You have to be careful about those things. But to a large degree, right, it seems to me, that was how we did it in the past, good money managers. And you'd flavor it with equities to give yourself some growth. Over time, over a longer period, your bonds mature, right? And you backfill in. I'm simplifying it, but I think the world has changed, right? We don't get the kinds of yields today that we could depend upon in the past.
Right.
It's why, I love what you've done in terms of calling it cash flow, not income, because it's sources of funds. When you look at someone's individual source and application of funds, right? The way we do it, we really tweak what their needs are, and then what are the sources they're going to be. They don't have to be taxable income or tax-free income in terms of municipal bonds, but it's cash flow.
Right.
And whether it's principal or income or interest or dividends doesn't really matter, right?
Right.
And let me just preface it, as you know, I think I'm a good example. I'm 69 years old, and I really can't ride these waves here because I have to admit myself that I'm not a kid, and that downturn in that tide can be a long period of time.
Sure.
I can't weather that storm at my age, right? But somebody else might feel the same way when they're 55 as opposed to 69. So, after my long-winded preface here, what I don't see out there are individual investors knowing a lot about things that we've done that I'm not even going to call them all that creative. They're not adventurous. They've been done in the institutional market for decades now by sophisticated institutional management firms. And that is looking to the investment banks, the credit-worthy investment banks, to take some of the risk out of the market for investors. And our clients certainly have the wherewithal to invest in the instruments I'm alluding to.
Sure.
And, a little bit of the time allowed, if you can just spend a few moments on just a few examples of how we get the investment banks to take some of that risk off the table. Not the nitty-gritty of it, but what does it look like for the investor in some of the instruments that, of course, you're well acquainted with?
Sure. And I think that the key here is that how do you balance the risks that are out there? No matter what investment you take on in your portfolio, there's some element of risk. And you are alluding to one when you talk about credit worthiness. So it's critical that when you make an investment and you use an investment bank as an example of a type of investment instrument you might utilize, that the ability for that investment bank to pay you back the money at some point in the future remains. So you always want to deal with a reputable company and a company that has the ability to honor their payments. Just like if you were putting money into a municipality, you would use a municipality that was strong, had a good tax base, and you knew that they would at some point be able to pay off the bond that you invest in. So in utilizing those vehicles, you realize that that's a risk you want to address. You also want to address the market risk. And by taking on perhaps some credit risk, you're trading that off for the ability to counteract some of the market risk. So in a investment through an investment bank that has some hedging, you would have the ability to invest in the stock market, but at the same time, while you're investing in the stock market, they would provide you some downside protection on the stock market. So perhaps you're buying an instrument that will pay you the rate of return of the S&P 500, so you're invested in blue chip US stocks, but they can be volatile. Go back to 2007, 2008, and the prices were down 35, 40%, 50% in some cases in those companies. So if you had a portfolio that was balanced along those lines, you could have lost that kind of money over a short period of time. But had you entered into a contract with an investment bank and they said that they would protect you for up to 20% of losses on your portfolio, then for the first 20% of that down cycle, you didn't lose any money. And then at the 21st, 22nd, 23rd, 24th, and 25th percentile decline, you were down 1, 2, 3, 4, 5%. So you've buffered the downside risk. And when you buffer 20%, you're saying, well, I think in the normal volatility of the stock market, I might be invested and I might see a down cycle and maybe it'll be 10, 15, 20, and you feel comfortable that you're hedging that. But if it's really bad and it's down 50, okay, I'm willing to take 30% off of my investments. I don't want to be down 50, but I'm willing to be down 30 if it's really bad. And you would do that in concert with other strategies that would maybe protect even more. But it's just a way to mitigate the risk of the big down cycle without giving up upside performance, because you're able to still participate if the market's doing well. So in combination, using vehicles that provide the downside hedging can also help you in just the composition of your portfolio. You talked about how typically we might see 60% of a portfolio invested in stocks and 35% in bonds and 5% in money market instruments. Typical balanced portfolio would look like that. And a lot of investors invest that way, and they look at, well, the long-term historical performance in that type portfolio has been 7-8% per year. The math doesn't work for that anymore, because 7 to 8% return in that type of portfolio presumes that the bonds in the portfolio may earn 5-6%. And right now we're looking at yields on bonds still being in the 2% range, and it's virtually mathematically impossible now to earn 5 to 6% on that portion of your portfolio. So what that means is that the equity portion of the portfolio, the stock market, has to do even better historically to get to that 7-8% rate of return. And given that we've had a cycle in the stock market that's provided rates of return a little bit above historical average, I would guess that maybe over the next decade we might be a little bit below average. So if you're really trying to build wealth and you're really trying to gauge what your portfolio will do for you in the future, you have to be realistic in what your expectations are. And I see a lot of people with expectations of 7 to 8%, and I think 5 to 6% is probably a better expectation going forward. And in that 5 to 6%, you would be experiencing perhaps more volatility, because you would tend to tilt your portfolio more towards equities to achieve that, even given the higher probability of higher return in the stock market. Over time, that's going to be more volatility in your portfolio. So that's where I feel the hedging, especially in the environment we're in right now, really comes into play, and it's important as a way to give you the opportunity to stay with a heavier equity emphasis in order to achieve those rates of return that you're trying from a benchmark standpoint to live up to. So it's challenging for investors, and I think a lot of people don't understand the dynamics of where we are in the low interest rate environment that we're in, how difficult it is going to be to achieve rates of return that are comparable to what we've seen in the last decade, the last 2 decades, the last 3 decades.
Yeah, and what I've seen you do, obviously very close, is develop portfolios of these obligations by very high creditworthy investment banks. It really is a portfolio of corporate bonds at the end of the day, is it not?
Yes.
In terms of the return to the investor, I'm going to be a bit more simplistic than you because that's how I think, but to the investor, right, they're going to see an index, they're going to see a portfolio, a diverse portfolio of investment banks standing behind these notes that they're issuing for clients like ours. So you have that diversity of credit,
Mm-hmm.
all high credit-worthy issuers. Many of these notes having downside buffering, as you call it, downside protection, and with preserving a significant portion, sometimes upside, even more than what that index will achieve.
Right.
And internally within these complex structures, they are doing what they are experts at.
Correct.
Right? They've got teams of people who are experts in options trading, and puts and calls, and zero coupon bonds and the like, in order to create these structures where the end result to the investor is what you've been talking about. What I've also witnessed, and maybe just spend one more moment on it here, is what I've witnessed you doing is side-by-side comparisons of looking at various investment banks that issue these instruments.
Right.
Which I think that's the beauty of being a strategic advisor, and
Mhm.
it's what we do and what
Right.
you do, right? When you've shown them to me, I've seen some pretty glaring differences in the terms that are pretty much apples and apples of the same index, the same, call it 3, 4, 5 year maturity period, but the terms of what they offer sometimes are really quite different.
They are.
So I assume that some are heavily laden in fees and expenses that we can help to cut out when
Sure.
you do that side by side comparison. True?
True, and really when you're looking at hiring a professional manager, the portfolio manager is the individual that's picking individual securities and making the decisions about where to invest the dollars from a tactical standpoint. When you're using a note offering through an investment bank, those managers are determining, well, what are the ways that we can hedge the market, and how can we deliver an investment vehicle that provides hedging while at the same time providing some upside opportunities that are appealing to the investor. So there is a lot of different products out there in the marketplace that are offered by various institutions. And our job as a manager of the portfolio managers is to really find the best that are out there. So I spent a lot of time looking at the offerings from many different investment banks, looking at the way that they manage money, what their success has been in the past, and really trying to pull it together in a way that is dovetailed around what the client's goals and objectives are, the cash flow that they need, the volatility that they're willing to accept. So I do my best to put myself in their shoes and find a way that the portfolio will mimic their level of risk tolerance and best chances for meeting their objectives.
Yeah.
It's just finding what's out there and being sensitive to what the client is willing to accept in terms of volatility and how to avoid risk and how to keep them asleep at night.
Yeah, you bet. And to finish up on our discussion today, I would like to suggest that perhaps in the next in our series, perhaps we'll show our audience some visuals of some detail of what we're talking about, because it's very detailed, it's very sophisticated, but I think you really have it down to an art form of how you communicate with clients and how you exhibit these items to smart people, but smart people who don't do what you do.
Sure.
So I think it's very telling. And I would just like to share with our audience that in our perspective, Sage Hill Family Office is a strategic family office. And in that sense, from an investment perspective of what we do for our clients, we are an assets under advisement firm, a so-called AUA firm. We are not a AUM firm, assets under management. We don't pick Xerox versus IBM versus GE and versus Apple and Microsoft. That's not what we do. So strategically, we're overseeing all of the assets for our clients and touching every single asset, whether it's their real estate, whether it's their financial assets, and we're advising on those assets as to how it affects their lives, the lives of people they love and care about, and the structure within which they own these assets within the goals that they define with our help. Thank you today for viewing our video, and we look forward to sharing some more information with you as we go forward. Have a great day.
Thank you.